Hello, my name is Doug Greenberg. I'm the president of Pacific Northwest Advisory. Thank you for watching January's 5 slides in 5 minutes. The landscape of employment across various sectors is witnessing a significant transformation. We're seeing some players in diverse industries taking steps to streamline their operations. Amazon's platform Twitch is set to reduce its workforce by a stunning 35%, a decisive move aimed at curbing losses after a couple of challenging financial quarters. Similarly, the banking giant Citigroup has announced a substantial downsizing plan, aiming to trim its workforce by 20,000 jobs, focusing on its Mexico business, which accounts for about 10% of its bank's workforce. Across the Atlantic, Telefonica is also tightening its belt with a 16% cut in its Spanish staff, a strategic decision to boost profitability and amid economic pressures. In the volatile world of cryptocurrency, the ripple effects are evident as well, with job postings plummeting by almost 60% according to data from LinkedIn, reflecting a cooling in hiring following the frenzied pace set by last year's market rally. Lastly, the investment heavyweight BlackRock is also optimizing its personnel, announcing a reduction of approximately 600 jobs. These shifts underscore a broader trend of recalibration as companies across the globe navigate their ever-evolving economic landscape, balancing the scales of workforce and profitability in response to market demands and financial imperatives. When it comes to navigating the choppy waters of investing, one fundamental truth stands out. Time in the market is your most steadfast ally. History tells us that stocks have been the heavyweights of long-term growth, delivering an impressive average real return of 6.8% since 1928. But this journey isn't without its bumps. The market's short-term volatility is a testament to its unpredictable nature. Despite this, over the span of 96 years, stocks have consistently outshone bonds and cash the majority of the time. This brings us to the heart of the matter, the cyclical ebb and flow of the financial markets. Just like nature's seasons, the realms of economy and investments move through cycles of growth and dormancy. Attempting to pinpoint the exact timing of these shifts is a Herculean task, often proving futile. This is where the strategies of diversification and resilience come into play. By choosing diversification, you're committing to a journey through various market climates, armed with a balanced mix of stocks, bonds, and cash. Think of it as an investment wardrobe prepared for all seasons. On the other hand, embracing stocks wholeheartedly requires a resilience akin to a seasoned sailor braving the high seas. You must be prepared to weather the storms and bask in the sunshine, all while keeping a steady hand on the wheel. In essence, your investment voyage is not about the destinations you choose, but about the time you spend navigating the market's waters. Embrace the journey, understand the cycles, and align your strategies with the rhythm of your own financial heartbeat. Remember, in the grand scheme of investing, time in the market is your most reliable compass. Credit contraction, or when it suddenly becomes harder to get a loan or credit, can really shake things up for all of us. Imagine you're planning to buy a new car or maybe a house, but suddenly the banks are being stingy with their loans, or the interest rates have shot up. This doesn't just put a dent in your plans, it ripples through the whole economy. Businesses, big and small, might hold off on growing or even just managing their day-to-day because they can't get the credit they need. This can mean fewer jobs and less money going around. And it's not just about buying things or growing businesses. People with loans or mortgages might find themselves squeezed, especially if they need to refinance, but the terms have gotten tougher. When people and companies start spending less, it affects everyone. Businesses earn less, so they might need to cut costs, often by reducing their workforce. This can lead to a vicious cycle of less spending and more job losses. In a nutshell, credit contraction can be the starting point of a slowdown that hits jobs, savings, and the overall health of our economy. That's why it's so important to keep an eye on these trends and understand how they might affect us all. Despite the economy doing pretty well in the third quarter of 2023, thanks to everyone out there spending and driving the economy, things might slow down a bit this year. When interest rates go up, It usually means borrowing money gets more expensive. Whether you're a family planning to buy a new house or a business looking to expand, higher interest rates can make you think twice. As a result, there's likely to be less investment, maybe some cutbacks in production, and even job growth might not be as strong. Experts are looking at the big picture, especially at the economies of the G20 countries, those big players in the global market. They're predicting that growth will cool down to about 1% in 2024. So while we've been on a pretty good run, it's like we're taking our foot off the gas a bit, easing into a slower pace as we adjust to these higher interest rates. All right, let's chat about what's going on with stocks and bonds these days. Think of bonds as a super safe savings account where the government pays you interest. Now, last year, the interest rate for a 10-year US government bond hit 5% in October, which is pretty high. That means if you bought a bond, you'd earn more money back. Since then, prices have moved around, but right now, US government bonds are kind of like that discounted item on the back shelf. They're cheap, and for those who are worried about the economy taking a downturn, they're looking very attractive. Bonds are expected to bounce back after a tough time, much like a bear waking up after a long winter. Now, stocks. That's a whole different ballgame. Unlike bonds, stocks are like owning a tiny piece of a company, and they can be a bit of a roller coaster. They're not looking as rosy as bonds for the coming year, and here's why. When bonds start looking good, it often means investors are playing it safe, which can mean they're less interested in taking the riskier bet on stocks. So for those thinking about where to put their money, it's a bit of a tug of war between the safe play with bonds and the wild ride with stocks. Thank you for watching, and if you have any questions, please let me know. Thank you.